We all watch the Fed, right? But what if the way most of us do it, hanging on every single word, trying to guess the next rate move, is just completely wrong? Today, we're going to break down a data-driven way to look at things that shifts the focus from predicting the future to actually understanding what's happening right now. I mean, think about it. You listen to the press conference, you read all the analysis, and you try to game out whether the next move is a hike, a cut, or a hold. It's basically like trying to predict a coin flip. And honestly, the market has probably already priced in what everyone expects long before the announcement even happens.
If that sounds familiar, hey, you are not alone. But the good news is there is a much more powerful way to think about all this. It's a method that stops you from guessing and starts showing you repeatable, data-backed patterns in the market.
So, what is this smarter way? Well, it's called regime analysis. And the whole idea is to stop predicting what the Fed will do and instead focus on what the economy is doing. Okay, so this is the crucial point. Regime analysis asks a totally different question. It's not, will they cut rates by 25 basis points? No, it's what kind of economic environment are we in at this very moment, and how have stocks historically performed in this exact environment? It's all about knowing what kind of ground you're standing on. So this whole idea breaks down into 5 distinct economic regimes. Now, to really see how this works, we're going to do a deep dive into the playbook for 2 of the most impactful ones from the last few years, rate hiking and high inflation. First up, the rate hiking regime. This is the environment we all just lived through, from late 2021 to early 2024, when the Fed was raising rates faster than they had in 40 years. So who wins and who loses in a world like that? Well, on one side, you've got the winners, companies that love strong economic activity and rising prices for raw materials. And on the other side, you've got the losers. These are typically those high-growth, rate-sensitive sectors. You know the ones. Their big profits are expected way out in the future, and those future dollars are just worth less today when interest rates are high. And just look at the difference here. It's absolutely massive. The median energy stock gained almost 17%, while the median communication services stock just plummeted by over 16%. I mean, that is a huge performance gap, and it's all driven by the economic regime. So the takeaway here is pretty clear. In a rate-hiking environment, energy is the undisputed king. At the same time, sectors whose profits are expected way down the line, think tech, healthcare, communications, they just get hammered. It's because those higher interest rates act like a discount on future earnings, shrinking what they're worth today. All right, let's move on to the next regime because this is where things get really interesting. This is the one the source calls the single most destructive for stocks. Get this. A third of all companies saw their worst performance during this kind of period. The dynamic here is simple, but it is brutal. The winners are companies with real, tangible assets and what's called pricing power, basically the ability to pass their rising costs on to you, the customer. And the losers? Yep, once again, it's those growth stocks whose future earnings look a whole lot less attractive when inflation is eating them away. And the numbers really tell the story. During the high inflation period from 2021 to 2023, energy once again just crushed it, posting a median return of over 22%. In fact, only 3 sectors even managed to stay in the green at all. Everyone else was losing money. But here's a really important detail. While the technology sector as a whole dropped 12%, some individual companies actually thrived. Take a cybersecurity leader like Palo Alto Networks, for instance. It delivered a stunning 33% return. This just proves that even inside a losing sector, really high-quality businesses can still find a way to win. And that brings us to a fascinating question. Are there companies out there that can do well no matter what the Fed does? The source calls these all-weather stocks, and it even measures them with something called a regime resilience score. Take a look at this number, 97.1. That is the resilience score for Quanta Services, an industrial company. A score that high means it has this remarkable ability to deliver positive returns across all sorts of different and often totally opposite economic environments. And Quanta isn't alone. You can see here a list of some of the top-scoring all-weather stocks. What's cool is they come from a mix of sectors, industrials, technology, financials, but they all share a few key things in common. So what's their secret sauce? Well, it really comes down to 4 things. First, that pricing power we talked about, like O'Reilly Automotive has. Second, they have non-cyclical demand for essential stuff, like the drugs from Vertex Pharmaceuticals. They also tend to not be super sensitive to interest rates. And maybe most importantly, they have a long history of just executing their business plan really, really well.
Okay, so we've looked at the history, we've gone through the playbook. Let's bring this all together and see how we can apply this framework to the market right now. So this is the core message, the big takeaway from the source material. Don't try to predict the next rate move. Instead, identify which regime you're in and position accordingly. It's a huge shift from forecasting to just observing.
As of March 2026, the data points to the current regime being an early cycle recovery. So what does that mean? Well, the Fed is holding steady after a series of cuts, and key indicators like the manufacturing PMI are above 50, which signals the economy is expanding. And history shows us that this kind of environment tends to favor cyclical sectors like tech, consumer discretionary, industrials, and financials as investors start moving away from those safe defensive stocks.
See? By focusing on the regime we're in right now, we can use history as a guide instead of trying to use a crystal ball. This entire analysis was built on data from FSF. If you want more explainers that cut through the noise just like this one, make sure to follow us and subscribe. Thanks for watching.